what is actually happening right now. Let me give you the facts first. No spin, just the numbers. As of this week, the US dollar index, which traders call the DXY, is sitting at around 97.96. That might not sound alarming on its own, but here's what matters. That's the lowest the dollar has traded in weeks, and it's part of a broader, slower trend that's been unfolding for years. Over the past month alone, the dollar has weakened almost 2.5%. Now, why is the dollar falling? In the short term, there are some specific things happening. Diplomatic news around ongoing energy market tensions has reduced the kind of fear driven demand that often pushes money into the dollar. Oil prices have eased back, and that removes one of the pressure points that was keeping the dollar elevated. And the Federal Reserve has made clear it is not planning to raise rates this year, which means investors aren't chasing higher dollar denominated returns the way they were a year ago. But here's what I want you to understand. Those short term factors matter, but they are not the real story. The real story is what's happening to the dollar's role in the world over the long term. According to the IMF's most recent data, the dollar share of global foreign exchange reserves has dropped to 56.8%, the lowest level since 1994. That's a 31-year low. Think about that. 31 years ago is before most smartphones existed, before the internet was mainstream, and in that entire period, the dollar has never had a smaller share of the world's reserve currency pie than it does today. So, what does that mean for you? It means the dollar's role as the unchallenged king of global reserves is quietly being eroded, not dramatically, not overnight, but steadily and persistently. And the people who manage retirement savings, who hold dollar denominated bonds, who keep their wealth in cash, they're the ones most exposed to that slow erosion. The debt behind the decline, here's where it gets more serious, and I want to take a moment here because I know this can feel overwhelming. I've sat with these numbers myself and felt the same thing. The United States national debt crossed $39 trillion. dollars. The Federal Reserve itself has commented that the current trajectory, not the current level, the trajectory is not sustainable over time. The IMF, in its April 2026 assessment, noted that the US deficit is expected to remain in the 7 to 7.5% of GDP range for the foreseeable future, with total debt potentially exceeding 140% of GDP by 2031 if the current path continues. And here's the number that I found genuinely striking when I looked it up. For the first time in history, annual interest payments on the US federal debt have surpassed $1 trillion. dollars. $1 trillion every year just to service the debt we already have. That's roughly equal to the entire US defense budget. Now, what does this have to do with the dollar? Everything. When a government runs large deficits and has to borrow heavily to keep going, the value of its currency over time tends to reflect that. The mechanism is simple. More borrowing means more bonds issued, which means more dollars in circulation, which means each individual dollar buys a little less than it used to. That's not a conspiracy theory, that's just how money works. The practical impact for someone protecting their retirement savings: cash held in dollars is not a neutral position. Inflation at 2.9% per year, which is where we were at the end of 2025, means your purchasing power is eroding even when nothing dramatic seems to be happening in the markets. Who is responding and how? Here's what I find most instructive about this moment. While most retail investors are watching headlines and worrying about day to day price moves, the world's central banks have been quietly making a very clear statement with their actions. In 2025, central banks around the world collectively purchased 863 tons of gold according to the World Gold Council. That number sounds abstract, so let me put it into context. Before 2022, central banks were buying around 400 to 500 tons a year. Then, starting in 2022, they went over 1,000 tons a year for 3 straight years. Even as the pace moderated slightly in 2025, 863 tons is still almost double the historical average from the prior decade. JP Morgan Global Research, one of the largest financial institutions in the world, has projected gold prices toward $5,000 per ounce by the fourth quarter of this year. Their analysis ties this directly to continued central bank demand and investor flows. And with gold currently trading at approximately $4,820 per ounce, as of this week, up around $1,489 from a year ago, the trajectory is not a mystery. It's a statement. Now, I'm not advocating you go and buy gold as I'm not a financial advisor and you should never take financial advice from someone random on YouTube. Plus, the technical analysis shows that after a significant run up of almost 60%, gold will certainly have a correction. But let's look long term. Here's what those central bank purchases tell me. The institutions that manage sovereign reserves, the boss banks as I call them, are diversifying away from dollar denominated assets and toward gold at a pace we haven't seen in a generation. This isn't panic selling of dollars, it's a slow, deliberate rebalancing, and it's been going on for years. And it's not just one or two nations. The buying has come from over 22 central banks. It's geographically widespread, it's policy driven, and it's happening in the same direction, which is toward gold and away from an over reliance on any single currency. The technical picture, when the macro fundamentals tell a story, I always like to check what the charts are saying because when both point in the same direction, you pay attention. The dollar index right now is showing what traders call a bearish consolidation, meaning it's not crashing, but it's also not finding buyers at any meaningful level. Key technical support has been identified around the 96.72 and 95.03 levels on the DXY. If those levels give way, we could see the next leg of the dollar decline accelerate. Gold, meanwhile, has been finding buyers every time it dips. The price came off from its all-time intraday high of over $5,500 earlier this year, then corrected meaningfully through February and March. But here's what's important, it held at around $4,720. Buyers stepped back in. And now we're climbing again back above $4,800, heading toward the levels that institutional forecasters have been pointing to. Silver is a different story this week, currently trading around $79 per ounce after a sharp 4% rally on Tuesday driven by a weaker dollar and softer producer price data. Silver's industrial role, over 50% of annual demand comes from manufacturing, solar, and electronics, gives it an additional driver that gold doesn't have. The Silver Institute has confirmed a sixth consecutive year of structural supply deficit in the silver market for 2026, with a projected shortfall of 67 million ounces. Supply hasn't caught up with demand for 6 straight years. That matters. When fundamentals and technicals are both pointing in the same direction, you pay attention to that. You don't panic, you think. Technical analysis, however, shows that in the short term, a correction can come in any time. The long-term trends are still strong. What this means for your portfolio, 3 things to act on. All right, let's bring this home. Because all of this only matters if it translates into something useful for how you're thinking about your own money. First, understand the difference between a dollar-denominated position and a real value position. Cash in a savings account is a dollar-denominated position. If the dollar loses value over time, as it has been doing structurally, the purchasing power of that cash declines even if the number on the statement stays the same. Physical gold is a real value position. It doesn't depend on any government's promise, it has no counterparty risk. This distinction isn't about being anti-dollar, it's about understanding what you actually hold and what risks come with it. Second, don't let short-term volatility rewrite your long-term thesis. Gold has had a significant correction this year. It fell from over $5,500 to around $4,720 in the span of weeks. That kind of move rattles people. I get it, I've watched positions drop and felt that pull to do something. But the structural reasons for holding gold, a weakening dollar reserve share, $39 trillion in debt, central banks buying at near record pace, none of those changed during that correction. The thesis didn't break, the price moved. Those are different things. Third, think about your allocation framework, not your allocation number. I'm not here to tell you exactly what percentage to hold. What I will say is this. Many financial planners historically suggested somewhere between 5% and 10% of a portfolio in hard assets like gold or silver as a hedge against currency debasement. With everything I've shown you today, a dollar at a 31-year reserve low, a $39 trillion debt pile, central banks buying gold at double the historical rate, it's worth asking yourself honestly, does your current allocation reflect what's actually happening in the world? Not what was happening 5 years ago, what's happening now. So here's where we are. Gold is at approximately $4,820 per ounce this week. The dollar is near 6-week lows. The IMF has confirmed the dollar's global reserve share is at its lowest point since 1994. And the world's central banks collectively purchased 863 tons of gold last year, nearly double the historical average. None of those facts have changed because of any news cycle. They're structural, they're slow moving, and that's exactly why so many people miss them. The real question for you isn't whether gold is going up or down next week. The real question is the portfolio you built designed for the world that existed 10 years ago or the world that exists today? That's the conversation worth having. If this video gave you something to think about, or if you're still working through what this means for your own situation, drop it in the comments. And if you're not subscribed yet, now's a good time. New video every week, practical, grounded, and built for people who are serious about protecting what they've worked to build. See you next week.